For last many quarters, FIs have been net seller from Indian stock market. But if you deep dive further, you would notice that FIs are not exiting everything. In fact, in certain pockets of market, they are doing the exact opposite. They are increasing their stake. Now this is where things start getting interesting because FIs don't operate randomly. They track global cycle, sectoral shift, management quality and long-term earning visibility. So when they selectively buy in a market where they are otherwise selling, it usually indicates that they are seeing something different in those businesses. That's where I've deep dived to identify 10 stocks where exactly the selective buying is happening. Having said this, let me make one point very clear. Just because FIs have been buyers in the recent past does not mean they will continue to buy going forward. Markets are dynamic and FIs can reduce their exposure in these companies. So the idea here is not to blindly follow FI activity or treat it as a buy signal. Think of this more like a starting point. When you see consistent buying in specific pockets, it simply gives you a direction, a hint on where to look deeper. But the actual investment decision should always come from your own understanding of the business, its fundamentals and long-term potential. And since we are in Q4 result season, it becomes extremely important to track numbers closely because that's where real signal comes from. It's not just price movement or news flow. And this is something I personally focus a lot. In fact, in my weekly series, I track quarter result of nearly 200 companies and document my knowledge in an Excel sheet. This helps in identifying investment opportunities. I also share my own investment thesis. So if you want to go deeper and track businesses beyond just surface level information, you can check that as well. With this, let's start with the stock list. So first stock in the list is not a typical manufacturing or consumption business. This is actually an exchange. Well, no marks for guessing, it's BSE. FIs have been consistent buyers in BSE since last 10-12 quarters from 7.9 to 12, 13, then slight reduction but again increased to 18, slightly reduced to 16% but again up in last 2 quarters now at 19.4%. Interestingly, even DIs continue to increase stake in the company in last 3 quarters and public holding has reduced significantly. Now BSE earning growth in the last few quarters has been extraordinary. Profits have jumped 10 times since March 23 and that has been reflected in the share price. So the obvious question is, where is this growth coming from and why FIs are still bullish? So the biggest growth driver has been the derivative segment. Historically, BSE was not very strong in derivatives, but over the last few quarters, there has been a significant increase in volumes, particularly in index option. And since derivative contribute a large portion of exchange revenues, even a small gain in market share can have a big impact on profitability. Since BSE is a platform business with relatively fixed cost, when volume increase, a large part of that additional revenue flows directly to profit. Companies' operating margins have zoomed from 20s to 30s, then 40s and now at 60%. That's why you are seeing earning growth much faster than revenue. Apart from derivative, the biggest driver for BSE growth has been the overall increase in market participation, as well as your strong listing activity and growth in other segments like mutual fund distribution in last few years. So the more activity happens in the market, the more revenue the exchange generates. So in a way, this is a direct play on financialization of savings in India. But at the same time, it's important to stay balanced. Derivative activity can be quite volatile and also subject to regulatory changes. If volume slows down or if there are changes in rules, earnings can get impacted. And that's the key risk one should keep in mind. So the real question to ask is whether this growth in BSE is sustainable and how much of it is already priced in. At the moment, BSE command a PE of PE. At the moment, BSE PE is in the range of 60s, which is certainly not cheap. But look at the ROE and ROCE, simply exceptional. Company is completely debt-free. And most important, it's a duopoly business with only 2 exchanges, BSE and NSE. Plus, company continue to grow at a fast rate. So it will command a premium. And considering the way both FIs and DIs have been increasing stake in last 2-3 quarters, it seems institutions are expecting BSE to continue to do well in the near future. Second company where FIs are bullish is from cables and wire segment. Company is Polycab. FIs are consistently increasing stake in Polycab since last 4 quarters. Again, Polycab has been on a high growth trajectory where both its revenue and profits have compounded at more than 20% rate in last 5 years. In fact, the growth is even higher in last 3 years and trailing 12 months. And that has been reflected in company share price as well. The question is, what is driving high growth for Polycab and why FIs are showing confidence in the company? So initially, the entire growth was largely driven by India's capex cycle. Real estate, infrastructure, power transmission, railway, renewable energy, everything requires cables and wires. So as government spending picked up and private capex slowly started recovering, demand for cables and wires increased significantly. That was the first leg of growth. At the same time, there has been a structural shift from unorganized to organized player. This is a very important but underrated factor. Smaller players struggled with quality standard, working capital and compliance, while larger branded players gained market share. And Polycab has been a direct beneficiary of that shift. Now the second layer of growth, which is more recent, is coming from new age themes like data centers, renewable power and digital infrastructure. With AI, cloud computing and increasing data consumption, there is a massive push towards building data center. And these are extremely cable intensive projects. Also, growing demand from renewable power like solar business is adding another growth driver. So indirectly, Polycab becomes a beneficiary of entire digital infrastructure built out. And since Polycab is market leader in the industry with 24 to 26% market share, FIs continue to show confidence in the company. But again, the question is, how much of the growth is already priced in? So today, Polycab commands a PE in 40s. If company can continue to grow at 20-25% rate, the valuations are justified. And the way FIs are increasing their stake, it seems they expect Polycab to continue to grow at good rate in near term. While the outlook is strong, it's important to keep an eye on commodity volatility in terms of your raw material prices of copper and aluminium, as they can put pressure on company's margin. The next company where FIs have shown interest is MCX. Similar to BSE, MCX is also an exchange but focused on commodities. So whether it is gold, silver, crude oil or base metal, MCX is the platform where a lot of that trading happens. Now FI's stake in MCX has increased from 19% to 26% in last 2 quarters. Again, MCX has shown exceptional growth in revenue and profit. Just look at the P&L. Its revenues were stagnant for many years and operating margin kept on falling till March 24. But then its growth simply exploded with 3 times jump in revenue and margin expanded from 9% to 67%. As a result, profit zoomed more than 10 times in last 2 years. Due to this, company share price that struggled for many years simply zoomed exponentially. The question is, what resulted in such explosive growth and why FIs are still bullish? So there are 3 reasons. The most significant trigger has been the successful migration from its old technology provider to its own indigenous platform. Previously, MCX paid a high percentage of its revenue as tech fee. Now it has its own platform. So that has resulted in margin expansion. But second bigger reason has been the massive commodity upcycle. Gold and silver has witnessed crazy growth in last 2 years and that resulted in high trading on MCX. Third reason is commodity traders have shifted aggressively towards option trading. Now valuation wise, MCX is already trading at high levels, but the way FIs have increased stake, it seems they are expecting high growth in near term. Having said this, one of the key risks of MCX is high dependence on commodities like crude oil, gold, silver and natural gas. If global market for these commodities enter a sideways or low volatility period, MCX revenue growth could reduce. Next stock where FIs are increasing stake is a PSU bank. It's Union Bank. FIs have been consistent buyers with stake increasing from 1% all the way to 7%. There was a slight reduction, but it has gone up to nearly 10% now. If you go back a few years, PSU banks were struggling with high NPA, weak balance sheet and very low return ratio. But over the last 3-4 years, there has been a clear turnaround in PSU bank sector. If you look at the numbers, Union Bank has seen strong improvement in asset quality, gross NPA and net NPAs have come down significantly, credit costs have reduced and balance sheet looks much cleaner compared to earlier. The bank has been able to grow its loan book across segment while also improving its deposit franchise. So from pure earning perspective, the bank has seen a sharp recovery. Profits have grown strongly and return ratios like ROA and ROE have improved meaningfully from earlier levels. Now this is where FIs might be seeing an opportunity because typically institutions look for sectors where there's a shift in cycle and PSU banks are clearly going through a phase of re-rating from stressed balance sheet to normalized profitability. Also valuation play a big role here. Even after the recent run-up, Union Bank command a price to book of around 1. Next company where FIs have increased stake is from CDMO space. It's Acutaas Chemical. FIs have been consistently increasing stakes since March 24 from 9% to 12, 15, 16, now at 19.5%. Again, Acutaas has been a high growth company with 5 years of revenue growth of 33% and earning growth at 44% CAGR rate. And that has been reflected in company share price as well. The reason for high growth is because Acutaas has moved aggressively into CDMO space. Management has set an ambitious goal to reach 1,000 crore in revenue from CDMO alone by FY28. Just for context, this target is roughly equivalent to their entire current business revenue. As global tech and pharma companies seek to diversify supply chain away from China, Acutaas is seen as a high quality alternative. Their US FDA and PMDA approved facilities make them a tier 1 global supplier, which is the exact type of quality play FIs look for in Indian mid-cap space. Plus, Acutaas has successfully diversified beyond pharma into semiconductor chemical and battery chemical. Acutaas has acquired South Korea-based company Indicam, and now they are India's only manufacturer of semiconductor-grade photoresist chemicals. Acutaas is also the first in India outside China to develop electrolyte additives at scale, positioning them perfectly for the EV battery boom. So from valuation perspective, Acutaas does command a premium valuation, but considering the growth potential, FIs continue to remain bullish on the company. Sixth company is a new age platform business. Company name is Blackbuck. FI's stake in the company has gone up from 11% all the way to 32%. It clearly shows FIs are quite bullish. Now, unlike traditional businesses, Blackbuck went through a degrowth phase in revenue till 2024. Operating margins were negative and so were the profits. However, there has been a sharp turnaround in last 2 years where revenue has jumped nearly 2 times, operating margin is now at 28% and company has become profitable. Basically, Blackbuck is a digital platform company in logistics space. Essentially, it connects truck operator with businesses and also provides services like payment, fuel management, tolling and financing for truck owners. So in a way, it is trying to build an entire ecosystem around the trucking industry. Now, if you step back, logistics in India is still highly fragmented and inefficient. A large part of the industry is unorganized with small fleet owners, limited access to credit and very little technology adoption. So any platform that can organize this ecosystem has a massive opportunity, and that's where this company is positioned. Maybe we can deep dive into Blackbuck business separately. Let me know in the comments. And with Blackbuck, FIs are betting on digitization of logistics and formalization of the trucking ecosystem and building a platform business in a largely underpenetrated market. But at the same time, this comes with its own set of risks. This is not a fully mature or stable business yet. Profitability can be inconsistent, execution risk could be high, and competition in logistics technology space is also increasing. So basically, it's a high risk, high reward kind of opportunity. There's no doubt that market opportunity is massive, but at the end of the day, it's all about execution. If company can execute well, sky's the limit. But any failure in execution can result in downside risk. In any case, it's a very interesting business worth tracking closely. Next two stocks are strong beneficiary of data center boom in India. First is Cummins India. FIs have been consistently increasing stake in Cummins India since last 4 quarters. Again, it has been on a high growth trajectory. Its stock has seen massive re-rating, and due to earning growth and valuation re-rating, Cummins share price has grown exponentially. Now, one of the biggest growth driver for the company is data center boom. The growth of AI-driven data center in India have created a surge in demand for high-quality backup power. Cummins power gen segment, which provide high horsepower generator set, has been the biggest beneficiary as these facilities require 100% uptime. The reason why FIs are still bullish on Cummins is probably because FIs view Cummins as a pure play on India's massive infrastructure spending. Cummins is primary provider of power solution for railway like Vande Bharat, freight corridors, then metro projects and large-scale manufacturing plant. Another reason is Cummins is heavily investing in hydrogen internal combustion engine and electrolyzer manufacturing. So while the opportunity still looks massive, one of the key risks with Cummins is high valuation. Stock is already trading much above the historical median. Any slowdown in government infra spending or delay in private capex cycle could lead to de-rating of stock. Then 8th stock is TD Power. It is one of the few rare companies where FIs have consistently increased stake in last 12 quarters from 2.6% all the way to 26%. Although promoter holding has reduced during the same time period, but again the growth in TD Power is extraordinary. It used to struggle till 2019 with flattish sale, low single-digit margin and negative profit. However, situation completely turned around and revenue jumped 3 times, operating margin expanded to 18%, and hence net profit simply exploded. As a result, stock also went through a massive re-rating, and that got reflected in share price return. Again, the biggest growth driver for TD Power is data center supercycle. Every large data center requires massive reliable backup power, and TD Power is a primary supplier of generators for gas engine and turbines used in these facilities. With global data center capacity expected to double by 2030, this has moved from a one-off order business to a multi-year growth engine. But similar to Cummins, or for that matter, almost every data center related stock, the biggest risk is premium valuation. TD Power is trading at very high valuation and market has already priced in near-term growth. So in spite of FIs buying TD Power, that shows their confidence, be careful of valuation as it looks quite stressed. In case you want to understand data center ecosystem in India, the opportunity, risk and key players, I've done 2 detailed videos. You'll get a good understanding. Next stock is a mid-tier private bank. It's Karur Vasya Bank. FIs have been increasing stake in this bank since last 5 quarters. The biggest reason is, over the last few years, Karur Vasya has gone through a cleanup phase. Asset quality has improved significantly with reduction in NPAs, credit and deposit growth has been healthy, return ratios like ROA and ROE look solid, and the earning growth has been super strong. Also, valuation plays a role here. In spite of superior growth in all segments, Karur Vasya valuations were very reasonable as compared to last year private bank. But now, the scope of valuation re-rating is less as bank already commanded fair valuation. Going forward, stock return would purely depend upon execution. But FIs buying in Karur Vasya shows that they are confident of bank doing well in the near term. Then final stock in the list is from precision manufacturing segment. Company name is Shaily Engineering. FI stake in company has significantly increased from 2% to 16% in last 7 quarters. Again, one thing is common, the earning trajectory. Shaily Engineering has delivered 4 times earning growth since March 24 and has already been reflected in the share price. Now, what is so special about Shaily Engineering that FIs are buying it big time since last many quarters? And why it has grown exponentially? The answer lies in the business model. Shaily Engineering has shifted from making simple plastic goods to complex medical devices like insulin pens and auto-injectors. And Shaily is riding the GLP-1 wave across the world, which is a weight loss drug creating massive buzz. Shaily is one of the few Indian firms with precision tools to manufacture the delivery pens required for GLP-1 drugs. And this business has grown exponentially in last few quarters. Although the stock has already witnessed massive re-rating, FIs are still betting on the fact that as mix shift towards further healthcare, which is a high margin business, companies' overall margins can expand further and companies' bottom line can grow much faster than its top line. Having said this, Shaily Engineering earning growth in future depends a lot on GLP-1 adoption. If the demand continues to explode, Shaily can benefit. However, if the demand fade, it can impact Shaily's business. In case you want to understand Shaily business in detail, you can explore my detailed analysis on the company. So if you step back and look at all these companies together, one pattern becomes very clear. FIs are not just buying randomly. They are consistently allocating capital to businesses where something is changing underneath. Either the business model is evolving, margins are expanding, or earnings are entering a completely different trajectory. In almost every case we discussed, there's a clear trigger. Whether it's a derivative-related growth in BSE, CDMO growth in Acutaas, capex cycle in Polycab, data center boom in Cummins and TD Power, platform scalability in M6 and Blackbuck, business improvement in Union Bank and Karur Vasya, or shift towards high-value segment like healthcare in Shaily. And because of this, earnings are not just growing, in many cases they're exploding. And that's the key point. FIs are willing to pay premium valuation, but only when they have confidence that the growth is strong, visible and sustainable. So instead of just focusing on whether a stock looks expensive or cheap, maybe the better question to ask is this a business that is transforming? Because that's exactly where institution money tends to flow. Having said this, just because FIs are buying does not mean it's a guaranteed opportunity. Valuations are already stressed in many of these names and execution needs to remain strong. So use this list as a starting point. Dig deeper into the business, understand the risk, and then take a call. Because in the end, it's not about following FIs. It's about understanding why they are doing what they are doing. So that's it from my side. Now tell me which of these business you find most promising. I'll see you in the next video. Till then, take care.